Well, it finally happened. After a couple of years, the Federal Reserve has finally announced an interest rate cut. On Wednesday, Jerome Powell announced that we would finally see an interest rate cut of 25 basis points. Many were speculating that we would get a bigger cut, and then there were some that thought that we might not get a cut at all this meeting. But Powell actually followed through and did give us a slight cut. That's despite some headlines that were painting a less optimistic view on the recent Fed meeting. Powell seemed concerned about the impact of Trump's tariffs on the economy and if that would lead to higher inflation. If that would have happened and inflation started shooting back up, then Powell would have reversed course on his decision to cut rates. But fortunately, that sky-high inflation thing didn't actually pan out like some media sources seem to be eagerly awaiting, although some higher inflation could still happen later. So now that we're officially getting rate cuts, what does that mean for the stock market and more specifically, dividend and high-income investors? In this video, I want to talk about the benefits as well as the potential downsides to these rate cuts. I'll also talk about specific investments and investment types and how they'll benefit or get worse. First, as a general rule, there's an inverse relationship that exists between interest rates and stock market performance. This is something that's been very well documented over the decades. As interest rates fall, then the stock market usually rises. It's not a perfect inverse relationship in that a specific rate cut will result in a certain percentage in the stock market rising. But the reason stocks go up is because of corporate optimism. With lower interest rates comes more businesses being able to do several things that'll result in better growth prospects. The most notable impact of interest rate cuts is the reduction of borrowing costs for businesses, making it more affordable to secure loans and lines of credit. When the Federal Reserve lowers its benchmark rate, banks can borrow from each other at a lower cost. This reduced cost of capital is then passed on to corporate customers in the form of lower interest rates on both new and existing variable rate loans. For corporations, this translates into immediate savings on debt payments, freeing up capital that can be used for expansion. Lower rates can also make it attractive for businesses to refinance existing high-interest debt, further improving their cash flow and financing health. This leads to another way companies benefit from rate cuts and the economy as a whole, which is with investments. Making large purchases like machinery, vehicles, real estate, and updated technology is now going to be less expensive. This higher demand for large purchases benefits the economy as it'll help grow GDP. Finally, a third major benefit to lower rates is it'll help create jobs. As companies save money and make investments that should result in expansion, it'll result in more jobs being created. However, at the same time, not everything is great when we see interest rate cuts. Although the benefits outweigh the negatives when it comes to rate cuts, the whole reason why the Fed cuts rates in the first place is because they anticipate a slowing economy. It's done to help boost the economy and entice businesses and consumers to spend more money and also invest their money in the stock market. So overall, I do think the rate cuts we got from the Fed on Wednesday was a good starting point. I think a lot of people were expecting the stock market to just start booming following the cut announcement, but that doesn't always happen. Sometimes the head of the Federal Reserve can say something that'll cause people to panic. But I don't want people to panic if the stock market doesn't soar in the days or weeks following our first rate cut. Rate cuts are good for companies and thus the stock market, but it can take time to start seeing the results from these rate cuts. Publicly listed companies only release their financials once every 3 months, so that should give you an idea of just how long it can take to start seeing the results. People have been wondering what my views are and if I think they should have been more aggressive in cutting rates this time around. I think that the Fed should take it nice and slow. And to be honest, one of my biggest reasons for saying that is because I have a lot of business development companies in mind. If Trump got his wish and the Fed board decided to cut rates drastically by 75 or 100 basis points right away, then that would be extremely chaotic for BDCs. The environment for BDCs has been getting tougher, and given the fact that the overwhelming majority of debt that's issued by BDCs is variable debt, they're going to be collecting less money now that we got our first rate cut. So for the sake of BDCs, I do appreciate the lower interest rate cut as it should be easier to manage for these businesses. But what should investors keep in mind about other dividend-paying investments? Like I previously said, the vast majority of sectors stand to benefit from lower rates. Specifically, companies that typically borrow large sums of money can benefit a lot more than others. And fortunately, a number of the higher-yielding asset classes rely on borrowing money. Let's start with energy and utilities. This is one sector that's actually kind of a mixed bag with rate cuts. When rates are high or when the economy is slowing down, then people often flock to these companies and these funds because they're a source of stability. People still need energy, no matter how the economy is doing, and they usually pay higher dividends, which also entices even non-dividend investors who still want to make money during a slower market. But lower rates means that they can expand their operations and also repair and upgrade infrastructure at a cheaper cost. So even though rate cuts will benefit these companies, it won't be a surprise if their share prices fall due to risk-averse investors trying to get back in on high-growth stocks. Real estate companies, like REITs, benefit because they pay most of their dividends to shareholders as they're legally required to. This means if they want to expand, they usually have to borrow money or issue new shares of their stock. But since borrowing costs are now going to be cheaper, they're going to be less likely to issue new shares, and they're going to be more likely to take out money to expand their portfolios. They can also borrow money to upgrade their existing real estate to make it more appealing to tenants. Investment vehicles that hold fixed income assets become more appealing as well. With the federal funds rate falling, treasuries are going to offer a lower yield. Many T-bill ETFs were yielding around 4.5% before rate cuts, which is a pretty good yield on an ultra-safe investment. So once these very safe options lower their payouts, it's going to make bonds more appealing to people who want steady income. Lower rates can also potentially result in fewer fixed income assets defaulting, as the companies who borrow from banks are less stressed financially. The same can be said about preferred stocks, which are investments that act more like bonds, even though they're technically stocks. It's also documented that preferred stocks typically rise when interest rates go down. So let me summarize the main points that I want to get across. Do not worry if we don't see the markets booming in the days or weeks following the rate cut. It takes months to see the results of a rate cut play out, and I highly suspect that the market may have already priced in a large part of this cut. We're going to have to wait a few months to see the results of this. Rate cuts are good, but like I mentioned, they can occur because the economy is weakening. If inflation does pick up, then that is a threat to share prices climbing higher. But Powell sounded confident that we would get additional rate cuts this year, which will be good news, assuming inflation stays down. Interest rate cuts benefit the majority of companies and sectors. Personally, I'm glad that we are getting a small cut to start, because it'll help business development companies adjust. Drastic cuts, I think, could be a threat to this sector, but Powell has never indicated that he wants to do this. But basically every other sector stands to benefit to a certain degree. Let me know your thoughts, as I'm sure plenty of people wanted a higher rate cut and would disagree with me. But with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.